Hey everybody, Real Estate Ninja here. I hope you're doing well. We're going to be talking today about real estate, but not only real estate, we're going to be talking about the ever-changing tide in real estate right now because real estate's starting to crash. That's right, sales are falling off a cliff. We all know that, it's all over the news. And I've talked to you about this before, how banks are going to start to do very interesting things to be able to lure more buyers in, and that is because they only make money when they're making loans, right? When they're writing loans, they make money. They essentially create money into existence from nothing. It's like poof. Federal Reserve goes, we give you our blessing, and then they get to make the interest off of it. I know it sounds crazy, but it's how it works. But the thing is people are buying less homes. They're buying less homes because the price of the home is too expensive when you also add in, it already is by itself, when you also add in the added cost of mortgage insurance, okay? Because that rate keeps going up. It's going to get worse. So banks have started to do adjustable rate mortgages, push those more. They're starting to do no doc loans where they're sitting there and saying, hey, you could verify your own income, things like that, just like we saw in 2005, 2006, okay, which led us to that crash. This one's going to be a lot worse. Now, check it out. Fannie Mae and Freddie Mac are involved, and they're going to be getting even deeper into this, and that is they're going to be loosening their standards on credit. So here we go. Oh, and real quick, I mean, to get a rate that's, good in comparison to what has been lately is, crazy to say the least. But, you have to have over an 800 FICO score. Anything under that, it seems like banks are wanting to sort of cast you aside or charge you exorbitant fees, points, or higher rates unless you have that high FICO score. So check this out, and I'm going to link this story below. Fannie Mae and Freddie Mac to use alternative credit scores, what that means for potential buyers. It says the federal government is expanding how it collects credit scores, which may allow more Americans to potentially buy homes. The Federal Housing Agency on Monday announced that at the Mortgage Bankers Association's annual conference that it had approved two credit score models, the FICO 10T and the Vantage Score 4.0, for use by Fannie and Freddie Mac. The enterprises have long relied on classic FICO, and it has met their basic needs, Sandra Thompson, director of the FHFA, said in Nashville, Tennessee. But it's time to recognize the significant innovations that have occurred in credit score modeling. Let me stop right there. There's no significant innovations in credit scores. It's that you're having a hard time qualifying with a straight face buyers that shouldn't be buying homes right now, okay? This is, again, leading us to the great crash. The banks are already hurting severely. Freddie and Fannie know that. They need to figure out a way to be able to stimulate lending, okay? Remember that. This is very, 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 very serious, all right? Vantage Score President and CEO Silvio Tavares said that the decision to include the company's credit model ushers in a new and more equitable era of financial inclusion, and added that the FHFA's action will enable millions more credit-worthy Americans to have access to mortgages. So let me stop there. I want to remind you, in 2008, during the Great Recession, which was caused by a mortgage-backed security debacle, which was caused because many Americans that should not have been allowed to buy a home because they did not have a big enough down payment and or a good enough stable income to be able to pay these exorbitant payments, right? Does it ring a bell? That led to this. Now they're saying, you know what, that's sort of a relic, and it's because they can't qualify you on those terms, okay? Those terms are too big, too hard to get people in, so we're gonna lower the bar. Okay, this is their nice way of telling you, we're going to lower the bar. We just want to get you in and out. Because remember, when the bank takes your home back, they're going to make their money a couple different ways. So this is very, very dangerous to a lot of potential buyers. It said Fannie and Freddie were institutions created by Congress and were federally backed mortgage institutions. They guarantee most of the mortgages made in the U.S., so many lenders follow the rules set out by Fannie and Freddie when they give mortgages to borrowers. Listen, this is why that right there, that phrase is so dangerous. You see, borrowers follow their guidelines? No, they use their guidelines because when the borrower can't pay the lender, then the lender goes back to the government and goes, hey, you need to give me a bailout because I did everything you said. I gave these people a loan because you said it was all right. This is very dangerous. Now you give us a bailout. That's what they're saying, okay? That's why they follow this. These are government-backed loans. The government says, don't worry, banks, we got your back. If they don't pay, we'll pay. And who really ultimately pays in this? That's the taxpayer. Very, very serious. For the last 2 decades, Fannie Mae, FNMA, and Freddie Mac, FMCC, have relied on scores created by FICO or Fair Isaac Corp. FICO to understand borrowers' ability to repay mortgage loans. Credit scores not only affect the underwriting of loans, they also impact the pricing of loans, pooling, investing, disclosures, and so on. This is very, very serious because remember, FICO wasn't even strong enough that the way those scores were made up so that banks would look at people's creditworthiness and go, okay, you've got what it takes, you've got a good history of paying, you can have this mortgage now and buy that house in 2004, 2005, and then only in 2008 to see those houses going back into the bank's hands. And not only did the bank get to make money off of that sale, they also went to Congress and got bailouts. Very, very serious, guys. This is proof positive that the market is tanking and tanking fast. When they have got to change the bar, they've got to lower the bar. They're walking away from FICO. They've got 2 different scores, new types of scores that they're using. This is serious, all right? It says here in 2017, a Senate bill proposed that the agencies adopt alternative scoring models, particularly due to the fact that traditional credit scores, like those created by FICO, only considered whether borrowers have paid debts such as mortgages and credit cards. Now, I remember back in 2015, 2016, this is when this all started, because we were having a hard time in 2015 giving out loans because we were headed for a recession. And the Federal Reserve, the dollar was losing value. The Federal Reserve had to start raising rates to bring value to the dollar. And that only lasted a couple of years because in 2018, we had a huge correction, a large, over 20% correction in the Dow Jones, and they did an about face. Point being is that they are trying their hardest to stimulate the economy, but they're doing it the wrong way. They're not doing it off of a solid rock foundation where it's no debt and the ability for companies to, less taxes so companies can grow and pay their people more wages. No, it is set up to where you're going to fail. And this is proof positive. And like right here, FICO 10T and VantageScore 4.0 are nothing like FICO. I can guarantee you that. They have absolutely lowered the bar. Now it says right here that both of those will take a look at a broader range of payment history data for borrowers from cell phone bills to utility and rental payments to determine creditworthiness. Now let me explain why that is. The last thing a consumer stops paying is their electric bill, their cell phone bill. Okay, understand that. The first thing during hard times, during a recession, that a consumer stops paying is their mortgage or their car payment. This is the big deal. Why? Those are big payments, and they also know that it takes a certain amount of time to come repo your car, and it takes even more time to come take your house. All right, so people need to realize that, how big of a deal that is. In the broad scope of things, this real estate market is crashing. I don't know why I got this guy's mug. And we need to realize that. Guys, if you're new to this channel, this is not the Economic Ninja channel. I know he looks a lot like me. I get that all the time. Hit the subscribe button, the thumbs up button. I'm gonna walk you through this economic collapse. And then on the backside, when all these banks take back the homes and they start selling them for pennies on the dollar, we're gonna go buy those homes. That's what we're going to do. All right, guys, thank you so much for watching. The Real Estate Ninja is out.